It's time for the Your Personal Bank Show with Ferenc Toth, president and founder of Secure Estate Management. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Hey, it's Ferenc. Welcome back. I'm excited about today's show. We're going to cover a lot of great information, and I'm going to just touch on a couple of things from previous and encourage you that if you want to check out more information in terms of like debt, taxes, compound interest, how a personal bank works, go to the moneyradio1510.com website. Check out podcasts. Go to local shows in Your Personal Bank Show, and you can listen to any of the previous shows where we go into more in depth on these topics that I just mentioned. You know, because I want to move forward and get into some more stuff in terms of like who really should look at your personal bank and why. So before I get into that, though, real quick, what is your personal bank? We're setting up an account that you have access and control to. You can gain tax-favored income, access, pass on to the heirs. The key is you have access to funds, short-term, if you need them, while building long-term compound tax-favored retirement income. This is a tool the wealthy have used for centuries, literally. In fact, it's on record, it's pretty well known, that the Rothschilds family is really the first family to really start using this tool on a regular basis. And they've been using it for, well, over 200 years, and they are recognized pretty much universally as the wealthiest family in the world. So it's not, I can name a lot of other famous names of people who have used this tool, worked with hundreds and hundreds of clients. I use it myself personally. Folks, it works. And it's made a financial difference in our family's life, our business, and many, many of our clients. So if you haven't looked at this, do yourself the favor and do so. I'm not going to say it's for everyone, but if you have not looked at it, do so. If you have looked at it, and I've run into a few people that are starting to get, the word is starting to get out a little bit, and that's kind of exciting for me because, you know, it's not an alternative investment. Gosh, this has been around for centuries. In fact, it's the way that people used to invest before the whole IRA 401k world was created, by the way. So this is nothing new, but it's kind of like going back to what used to work for our parents and our grandparents, okay? And it's kind of cool to bring back something that really worked long-term for a lot of people and re-educating, if you will. It's almost like a lost art or a lost science, and we're bringing it back. So if you have, and like I said, that's starting to happen, well, if you have, most likely you didn't do it because there wasn't enough cash particularly available in the early years, which caused the cash growth going forward to be less than stellar. We'll put it that way. Well, here's the reason why, when you looked at that, it didn't work. Here's a simple little trick. It's a secret, if you will. I'm going to share with you, and I shared it in last week's show. How do you know if the personal bank tool that you're looking at is designed to maximize cash? Here's the secret. I'm going to throw it out there right away today. I put it later in the segments last week, but guess what? We're going to put it out there right away. So here's the secret to know whether your tool is designed to maximize cash. You look at the illustration and you look at first-year cash numbers. And if the cash is not at least 50% or more of what you contribute available to you, first year, day one, then your tool is not structured to maximize cash. It's just that simple. There's a lot of reasons for that. I won't go into all those in detail. If you want to find out more information, contact us on yourpersonalbank.com or toll free 866-515-6280. We can do a comparative analysis and explain to you the reasons why the one you're looking at is not designed to maximize cash versus what we're showing you. And by the way, when we do those comparisons, in most cases, we're showing people anywhere from 30, 40, 50% more cash day one and every year the rest of their lives. That's the experience that we've been having doing this for a number of years now. So again, most cases when you're looking at this, you looked at a tool that really wasn't designed to maximize cash. Now, what do I mean by that? Well, the tool that's used commonly for the Your Personal Bank concept is an insurance tool. Now, it's a very specific type, not one that most people have had experience or familiarity with. Most have not been introduced to this tool, but it's a high cash value and insurance tool is what it is. And the key to that is maximizing cash versus what most people use insurance for, which is to maximize death benefit protection. In other words, most people look at insurance as an expense, not an investment. And what I mean by that is, most people, when they're looking at insurance, they think, okay, what's the least amount I can pay? What's the smallest premium to generate the largest death benefit? And if you're looking at a death benefit protection tool, that's exactly what you should be doing. What's the least amount of money I can put out to get the biggest benefit to protect my loved ones in case something happens? If you have death benefit protection needs, by all means, do that. We can get you quotes and compare, but that's not what I'm really here to talk to you about today. But so should you take care of that? Of course you should. But again, what we're trying to accomplish is maximizing cash. In other words, think of a teeter-totter. Most insurance contracts are designed to maximize death benefit. Term insurance, for example, is exactly designed for that. Low or no cash. Term has no cash. It's a death benefit protection tool, period, for a certain period of time. That's what term is. Our goal is to maximize the cash. They flip the teeter-totter the other way. Maximize the cash, minimize the death benefit so we can get as much cash growth as possible, and ideally on a tax-favored basis. Now, there are rules out there. There's tax rules. One of them is called the MEC rule, or the Modified Endowment Contract. You can look it up. It's been around for decades, and it gives us limitations in terms of how much cash to death benefit ratios that can be accumulated or contributed to or built in over time. Our goal is to maximize the amount of cash that can be done up to the MEC limits, the Modified Endowment Contract, to maximize cash growth, minimize death benefit within the limits, within the rules, okay? And that's why I'm saying the 50% rule is a pretty good rule of thumb in most cases. Again, everyone's different. It's all based on a number of factors: age, health, income, assets. All those different factors come into play. So not everybody's going to be the exact same number, but that's a 50% plus is a good rule of thumb. And by the way, in our experience, most of our folks are getting 75, 80% plus access day one, first year, day one. Again, the goal isn't so much an access, although for some people it could be. The main purpose, the long-term purpose, is to grow cash tax-favored for retirement, right? What's nice is most investments require you to have one or the other. You can get safety without access. You can get long-term growth, but you can't touch it. Or you can have short-term access and get little or no returns, right? That's sort of the dilemma of the three main areas of money, if you will. Long-term growth, can't touch, right? Or you have limitations, taxes, penalties, various other things. You can get short-term, you can get safe money, but again, limitations in most cases to access, very limited access. Annuities, for example, allow you 10% a year in most cases. CDs, you get access. If you have a one-year CD, you have access about 10 days a year. Every year you renew it, okay? You got safety, but you don't have access. Okay, what your personal bank does is it encompasses all of those things. You get the long-term growth. You get the tax-favored benefits. You get the access to the funds if you want or need them. It's the best of all those worlds, and you get a long-term care benefit thrown in at no additional cost, which can be expensive over time, and a death benefit thrown in, although minimized. There still is one. God forbid that that unexpected thing happens and you want to protect your loved ones. It's pretty cool how it works. It changes financial futures of individuals, families, and businesses. Now, like I was saying this in last week, there's three different options to going into how we can, fund these things. There's a fixed, there's an index option, then there's a leveraged option. In the next segment, we're going to go into more detail about how each of those work and what people or who should be looking at it, and answering some questions I've been getting from a number of people that have been looking at this and expressing a lot of interest. It's been a lot of fun sharing this idea and this concept. For most people, for them, first time ever. It's a new thing. So listen in the next segment. We'll talk about those things. If you have further questions, you want more information, feel free to contact us at yourpersonalbank.com or toll free 866-515-6280.
For more information on Your Personal Bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ferenc Toth.
Welcome back to Your Personal Bank Show. It's Ferenc, having a lot of fun, sharing a lot of great information in terms of how to maximize cash, tax favored, long term, have access to the money short term if you need it, protect the downside, eliminate market risk, all that good stuff. And that's the kind of thing a lot of people are looking for these days. There's a lot of uncertainty out there today in the markets, and people are looking for that move to safety. Your personal bank certainly is something you should consider. It's not for everyone, but certainly you should consider and take a look at. And like I said, the secret I shared it earlier. How do you know if this is, I'm going to tell you right off the bat, if you're looking at this as a financial tool, look at the first year cash values. If it's not over 50%, first year, day one, you do not have a tool designed to maximize cash, plain and simple. And again, most of our clients in most cases are upwards of 75 to 80% or more of their cash available short term if they need it. Again, some for the passive investors I spoke about earlier, that's not a major concern. It's nice to know you have access to the money because you're growing it long term. It's for rainy day, it's for college funding, it's for retirement, or it's maybe a credit facility for your business. Any of those types of things, and you're doing it through the fixed index or leveraged options, supplementing retirement if you're an executive business owner, those kinds of things. But really, it's long-term money, so you're not as concerned about the short-term access to needs of the fund. But guess what? Stuff happens. Life happens. Opportunities occur and emergencies happen, and it's nice to know the money's there if you need it and still access it, yet if you can you have the opportunity to access it short term at a very low cost while still gaining the money's compound growth long term. See, you don't have that option with other investments. If you take the money out, I always tell people, look, you have a $100,000 account. You take the $100,000. What's your return next year? 0. You spent the money. Here, you can have access, like I said, year one, somewhere in the range of 50 to 85%. After several more years, 100% of the money, you could, or nearly 100% of the money, you could access it at a very low cost. If you're able to bring it back in, say within that year, that policy year, you can in effect continue your compound interest as if the money had never been gone. Where in other accounts, it's just gone. You killed compound interest. Why is that so important? Well, remember, compound interest, 1 to 2, 2 to 4, 4 to 8, and so on. What you do is you kill the future down the road. The retirement monies, the time when you're going to have substantially increased monies growing because of compounding, and you would have killed it in the previous decades. It's very important to understand short-term access while still maintaining long-term compound growth. Powerful concept, powerful tool to understand. If you want more information on that, contact us at yourpersonalbank.com or toll-free 866-515-6280. Now, I want to talk to my entrepreneurial friends. I've shared this many times. I've actually owned 4 businesses. I'm starting in the process of a 5th. I'm the chairman of the board of a community bank here in Arizona. We're in the process of formation. We're working on opening this bank. I've actually started 3 other companies. Owned a retail business, service company. I owned a financial insurance agency the last 15 plus years. I'm an entrepreneur at heart. So I'm what I consider defined as an active investor. So what's an active investor? See, we all know what a passive investor is. They contribute money. It grows over time. They have, if you do the personal bank, you can have consistent growth, either fixed or index option, with no downside market risk on either side. You have access to your funds, as I stated many times, if you needed, for emergencies, whatever. You have a long-term care benefit built in at no additional cost. You have a death benefit protection for your heirs. Something happens. Again, we're not trying to maximize it, but there is still one there. And we're building tax-favored income for retirement, college funding, various other purposes. What's an active investor? Well, an active investor we define as someone who invests his time into earning and allocating dollars. And those are your entrepreneurs. If you get a 1099 or you own an entity, LLC, corporation, stuff like that, you're an active investor, okay? Now, here's the challenge with active investors, entrepreneurs, and things like that. A lot of the investment tools out there that exist don't fit very well for us. here's what I mean. We want to put money away for retirement. What are we all told to do? Do IRA, 401ks, things like that, right? The qualified accounts. Well, depending on your age, as we all know, there's tax penalties to accessing those funds prior to age 59 and a half. So if you're a younger entrepreneur under that age, if you want to access those funds because you have a business opportunity, you've got a tax penalty to deal with. Okay? That's no fun. All right. 401ks, I had a business owner, client of mine, contact me a little while ago, said, all my friends are telling me to do a 401k. And I asked her a simple question. I said, well, these friends you're talking about, do they have jobs or do they have businesses? She goes, well, they all have jobs. I said, I said, in most cases, I would guess that they're getting company matches on those 401ks. She goes, yeah, they are. That's great. If you have a job that has a 401k and the company matches, should you do it? Yes, it's free money. Take it. Some would argue it's part of your compensation package, so it's not really free, but hey, it's money. They're giving to you. Take it, right? I said to her, this business owner, I said, if you set up a 401k, who's doing the match? She goes, well, I am. It's my business. I said, exactly. So what's the point? Also, I happen to know her business well enough that she's had needs for access to monies at different times, and she's well under 59 and a half. So I said to her, remember in a couple of situations where you needed money to expand your business or you needed this to keep your license active, things like that? She goes, yes. And I said, remember when you accessed funds from your personal bank? She goes, I do. If you had it in an IRA or 401k, one, you would have had to pay the tax on it, and two, you would have had a penalty. She goes, oh. I said, exactly. My point is simple. For that active investor, that entrepreneur, somebody that gets the 1099, the whatever, owns entities, you have a greater need in most cases for access to capital than other folks do. Like I said, I'm talking to my entrepreneur types right here. Or if I want to be an entrepreneur, how about having a credit facility that you've set up for yourself where you have access to the funds without any credit checks, without any loan applications, no questions asked. You need the funds. You want the funds. You have access to the funds at a very low cost. Like the current loan fee right now is like 0.5%. Where can you go today? You're let's say you're a real estate investor, business owner, or you're any own business and you need funds to expand your business or purchase a property or whatever it is you're doing. Where can you get money without any questions asked, without loan applications and all that for 0.5%? Cost. I don't know of anywhere else that you can do that. This is why your active investors, your entrepreneurs, your business owners, your real estate investors, all those different types of folks love this tool. Having access to those monies to take advantage of those opportunities where they can get the money in a day or two if need be, to take advantage of that opportunity. Hey, folks, in the business world, stuff happens fast. And many times, when you see an opportunity, you got to act upon it. You got to be able to come up with money in a matter of days, in many cases. You know, a traditional loan from a bank just doesn't work in that scenario. You may have a line of credit on your house or something like that to take advantage of those kinds of things. But the reality is you've got to have that access to cash to take advantage of those business opportunities that occur. Otherwise, you miss out, your business doesn't grow, and sometimes it dies because it can't grow and evolve in this economy and the way things move. You've got to have that ability. Otherwise, as a Small Business Administration shares, 50% of small businesses fail in the first 5 years for two major reasons. One, lack of experience. Two, lack of access to capital. Those are the two main reasons for business failures, again, according to the Small Business Administration. So take care of one of those by using a personal bank and contributing funds so you've got them. You can use them if you need them to take advantage of those opportunities. And then, down the road, you create a long-term retirement for yourself, tax-favored. It's a great combination. Plus, you're taking care of the long-term care and the death benefit protection needs that you have with that business typically anyway. So, for more information, contact us at yourpersonalbank.com or toll-free 866-515-6280. On the next segment, we're going to just answer a few other questions and who should be looking at a personal bank for themselves.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ferenc Toth.
Welcome back to Your Personal Bank Show. We've been covering some great stuff in terms of how to maximize cash growth, access to the funds, all on tax-favored basis, so you get the long-term tax-favored cash growth for retirement and other needs, while having access short-term for those opportunities that present themselves and those emergencies that happen in life that happen. So there's three different options, as I was starting to say in the last segment, in terms of how you can fund these things. And so depending on the person and your goals and your fit, we can go any of these options. We can go with the fixed. The fixed is consistent, regular returns, guaranteed and insured. It's a steady eddy, if you will. The money will grow every year on a consistent and regular basis. And for those people that's important to, that's a great fit. You want to have that consistency of returns, okay? Again, on all these options, you're growing money long term, but you're also having access in the short term if you want or need it. The second option is the indexed. And the indexed option is typically based on indexes like the S&P 500. And the key to this is the principal is guaranteed. You're not going to have any downside market risk. That's a very favorable thing. So the bottom line is, on good market years, you can see double-digit, crediting. Okay, and in bad market years, which a lot of people are concerned, the market cycles and where things have been, you don't have any downside risk. So in other words, your account will never go down in terms of the interest crediting. You'll always get it. You'll never get a negative interest crediting. Now, to be fair, there's some costs and fees involved with the account, so you would still have those, but you wouldn't have the losses. And by the way, the costs and fees on most of these, just so you know, historically, it was going over many of these cases that we deal with, I see stuff like 0.5% to 1% is typical over the long term of the account, over the lifetime of their account, which compares very favorably to other investments that are out there that don't have a lot of the benefits here in terms of things like downside market protection, okay? The index option certainly has a significant upside potential. Like I mentioned, double-digit potentials and things like that. So if you're looking for, I want to still get growth, but I don't want to experience those downside market cycles, I want to protect the downside, the index can be a great option for you. And then, of course, there's the third option is the leveraged. And leverage is really, it's like the index where you get the potential upside without the downside losses, but you're now partnering with a lender. A lender is contributing to your account along with you, and what that means is now with two parties contributing, a whole lot more money is going in. And in many cases, in most cases, the lenders are putting in a much bigger percentage of the money than you are, and then they later take their portion back out plus some interest. But at the end of the day, you have a lot more cash for retirement, for example, than you would have if you had contributed to it by yourself. Who is that a good fit for? I see that used a lot in executive bonus plans, and I was just talking to a few weeks ago a new partner of a law firm. This is used extensively in those arenas as a way to enhance retirement or supplement retirement in a tax-favored manner. So it's pretty exciting in terms of what can be done and how it can be used, the personal bank, in terms of these different situations. And who should look at this? Now, like I said, it's not for everyone. Not everybody's going to do this, but you certainly should look at it. And I find very few people have ever really been introduced or really looked at this. In fact, in most cases that I deal with, it's their first time. And so it's like a paradigm shift in thinking about money. First thing we have to do is identify whether you're what we define as a passive investor versus an active investor. Now, what's the difference? A passive investor is basically somebody who contributes money into an account. And you can do that into a personal bank account or many other investments out there, and you're going to earn over time. Now, you can have that consistent growth, either in the fixed or index options, as I explained earlier. The benefit here is no downside market risk. So that investor who is risk adverse, who's concerned about where the market is at, whether it's this cycle or any cycle, maybe there's been lots of growth. There's been a lot of growth. We've had the longest bull market in history, over 10 years. That's a fact. They're concerned about where the future is going to go. Where is the future? Are we going to see a a recession? Are we going to see a downturn? You want to protect against those kinds of things. The risk-adverse investor. Well, this is a great tool because, again, the downside, the principal is protected. It's guaranteed. You're not going to lose. You're not going to go backwards. And if you take the fixed option, the consistent guaranteed option, you're going to have growth every year on a consistent, regular basis. Okay? So right there, that risk-adverse investor, this is a person that person should really take a look at this. I see a lot of people when they're concerned about the economic cycles. Like I said, I've been doing this 22 years. I've seen 3 economic cycles. This is nothing new. Will market cycles happen? Yes. Now the question is, the answer is when. Nobody knows. How long? No one knows. How much? No one knows. If somebody's trying to tell you that they know when those things are going to happen, or they got some software that can predict that stuff, well, it may or may not be correct. You know, there's really no way. And a joke I often say to people is, look, if I knew when the market was going to do what it was going to do, or that's like knowing when a certain sports team is going to win or not, and you just know for sure, like you have a time machine. If you remember that Back to the Future movie many years ago, where the guy went back and he had the almanac of who won the Super Bowl every year or something like that, and he went back in time. He was able to bet on those games. That's a sure thing. You know, if you knew when the market and the economy was going to take a downturn, and if you knew how far and how long, I don't think I would be here. I'd probably be on some beach somewhere sipping a tropical drink, and I think most anybody else would be too. We can't predict the future. What we can say is there will be another cycle. We know it's going to correct. We know it's going to go down. We just don't know when, how long, or how much. And a lot of people move to cash and move to safer alternatives and things like that to try to avoid that. Unfortunately, what I see is most people just ride the roller coaster. They just hang in there, you know, stay in for the long term, hang in there, it'll get better. We've heard all those things. And they ride the roller coaster. And, you know, yeah, it will get better. I'm not arguing that point. But they get very frustrated about riding the downward cycle of that roller coaster. And emotionally, it takes a toll, and it creates financial stress. And some people have come to realize that's not worth it. And if you're that type of person who's risk adverse and it's just not worth it, some are fine with it. They're going to ride it and go on to the next cycle and do what they do. That's fine. This is a personality thing, if you will. And it's also a stage in life thing, partially. We tend to get more conservative as we get near retirement, as we get older, for a lot of reasons. So if you're that risk-adverse investor, instead of moving to cash or moving to something that's, you know, has some guarantees or safety, but has little or no return, why not look at a personal bank? At least you're safe. You're guaranteed to the downside market protection. You don't need to, you know, worry about that side of it. You have access to your funds if you need them. A lot of people move to annuities. You know, every time the market goes down, we see a downward cycle, you see annuity sales spike. It's because people are moving to safety. And annuities, fixed in index annuities, have that downside market protection, which is great and which is what a lot of people are looking for. Here's the challenge with annuities. As most people know, the one bugaboo about annuities is access. You know, there's limited access to the money. CDs have the same limitation. They're safe. They're guaranteed. CDs are FDIC insured, as long as you don't over the limits. But you don't have access to the funds except if you have a one-year CD, 10 days each year as you renew the CD, for example. Annuities, most annuities have 10% free withdrawals annually after the first year. Now, for some people, that's fine because the move to safety is more important than the access. But for others, it's not. Why not look at a personal bank? You can get similar returns as annuities, oftentimes better, with the same type of safety, but now having access to half or more of the funds, in most cases, upwards of 80%. That's a big difference from an annuity and having the same safety. My point is it's worth looking at. On this next segment, I'm going to talk to my entrepreneurial friends because those are the folks that need access to cash for opportunities. And who are entrepreneurs? We'll talk about that in the next segment. Listen every Tuesday at noon, Your Personal Bank Show, and contact us for more information at yourpersonalbank.com or toll free 866-515-6280.
For more information on your personal bank, call Ference at 866-515-6280 or online at yourpersonalbank.com. Back to Your Personal Bank Show with President and Founder of Secure Estate Management, Ference Toth.
Welcome back. We're rounded third, and we've been covering a lot of great stuff today in terms of how to maximize cash long-term, tax-favored for retirement, college funding, various other longer-term investment purposes. Also having access to those funds short-term for those opportunities that occur in life and for those emergencies that happen to us in life. So here's the thing. I've been talking a lot about passive and active investors. And what's the difference? A passive investor, again, is very, most are familiar with, contributing money to an investment account, whatever it is. Money grows over time. You get, if you do a personal bank, you're going to get consistent growth. You can, whether you're fixed or index options, either way, you've got principal protection. You're not going to lose if the markets go the wrong way. Also, you have access to capital. Unlike a lot of fixed or guaranteed options of investments out there like CDs and many annuities have very limited access to capital, okay? Well, here you've got access to at least 50% or more of the monies day one if you need them. And again, if you're looking and comparing at one of these tools, look at the first-year cash value. This is one of the big secrets. I've been sharing this in terms of knowing whether your tool is designed to maximize cash. You have at least half or more of the monies available day one. What other investment tool out there has access to half the money or more day one and protects the downside? See, that's interesting. That's hard. You think about it. I'm not aware of one. I'm not saying it doesn't exist, but think about that. That is powerful, okay? And you have access to the money, and if you do pay it back, again, it costs very low. If you do pay it back within that anniversary year, you can continue the compounding, long-term compound interest growth going forward as if the money had never been gone and as if it had been there the whole time. It is super cool because if you understand compound interest, that is a massively powerful concept. One goes to 2, 2 to 4, 4 to 8, and so on. That's how compound interest works. And whenever you take money from an account, you kill the future compounding. Here you have the ability to take money short-term because you need it or want it for an opportunity, yet still take advantage of the long-term compounding. When you put those two pieces together, it becomes amazing in terms of the financial difference. See, I've been doing this for now 6-7 years, working with clients on the personal bank concept, been in the financial industry over 22 years. And, I was one of the top annuity producers in the country for a number of years. And people say, annuities? Well, annuities have a fit. This is one of my pet peeves. I've shared this all the time. There's no such thing as a bad financial tool. In fact, there's competitors and there's better ones than others, but they all have a purpose. And the purpose of most fixed and index annuities is twofold. Either somebody wants to get growth, an index annuity is market related, a fixed is a fixed rate. They want growth in their account without downside market risk. They don't want to lose. And there's a lot of people out there that fit that bill. Okay, that's why annuities keep selling pretty much more and more every year, billions of dollars of it now in the United States, because so many people have seen the wisdom of protecting the downside, much like bankers do. I talk about that a lot, thinking like a banker. The other reason why people purchase fixed and index annuities is they want to create a guaranteed income stream down the road. The guaranteed lifetime income riders on many annuity products are very powerful and strong, where they can get an increase on the amount of money that they're going to get in a quote-unquote pension-type check guaranteed for the rest of their life, okay? So people want either growth without downside risk, or they want to create a future pension check. That's the two primary reasons for purchasing a fixed or index annuity. Well, I dealt with that for many, many years. It was a powerful tool, despite some people's attacking those tools. Seems like it's a favorite thing to attack. But as I point out, for the person that's looking for either the growth with safety or looking for that guaranteed pension check, if you will, supplement their retirement, it's a great tool. Well, you can accomplish either of those things with the personal bank concept, the personal bank tool, with the additional benefit of having access to a majority of your funds if you do indeed need them. Because here's the challenge of annuities. Here's the weakness or the thing that people always attack. Limited access to the funds. And that is true in most cases. Most annuities only allow 10% per year free withdrawals after the first year until, you've owned it long enough, 5, 7, 10 years in most cases. Then you have access to the funds, but you got to wait 5, 7, 10 years, depending on which product you're dealing with. Well, with a personal bank, you're going to have 50 to 85% available day one, which is better. Oh, by the way, the personal bank has long-term care benefits attached at no additional cost. Long-term care is a big deal. It's a big issue. The studies, I've read so many articles on this over the years, it's not even funny. Something like 95% of Americans nearing retirement age do not have long-term care, and the ones that do, the costs can be quite prohibitive. Here it is built in if you need it. One of my favorite things to say is, look, if you want it or need it, you got it. If you don't, you didn't any pay extra for it. What could be better than that? You also have a death protection built in. It's not our primary purpose here. We're trying to maximize cash, as I say repeatedly, but there is a death benefit. And study after study shows this too. Statistics show that most Americans are vastly underinsured. In other words, if something catastrophic happened, their family, their business would be devastated. Here you have this built in. You're trying to grow. Your main goal is to grow cash, but you've taken care of another problem, a death benefit protection problem or need that you have. And you're creating tax-favored income for retirement. So it's really why I've devoted most of my time and energy. Yes, we still do some of these other things like the annuities and whatnot, as I said. But most of our time and energy is focused towards the personal bank concept in that direction because it accomplishes so many of the needs for so many people. The risk-adverse investor, we've taken care of that. There's no downside market risk. Yet they can get growth, either consistent, steady Eddie, or market or index-related, where they can get nice double-digit returns in good years and don't lose in bad years. For the business owner who needs access to funds, access to capitals, the entrepreneur, it's a credit facility for that person. What about the college investor? Somebody's investing for college, for the kids or grandkids for college. This is one of the best tools for college funding that exists. One of the big reasons is it does not count as an asset for the FAFSA form, which is the form that is used to qualify for student loans and grants. Your 529 plans and other investments that exist out there are included in FAFSA forms, are included for those types of things, which can impact whether or not the student gets a grant or a loan or how much. This doesn't impact that at all. And another cool thing about the personal bank is, versus other college funding tools, in most cases with 529 plans and various other things, the money is tax favored if used for higher education, but you lose the tax benefits if it's not used for those purposes. What do I mean? Well, what if your kid or grandkid, you're putting this money away for that purpose, and they end up either, one, not going to college, or two, they get scholarships and whatever, so they don't need the money for college. You lose the tax benefits. With a personal bank, you can set aside this money for any purpose. If it's used for college, great, it'll be tax favored. If it's used for retirement, great, it'll be tax favored. My point is you don't lose the tax benefits for no matter what it's used for. Wealthy families use this as a tool often to help kids get started. Helps a lot of times. It buys the grandparents will purchase this many times for grandkids in wealthy families, and they'll pay for their kids' first car, pay for college, pay for their first house, their first business, and ultimately supplement retirement, all in a tax-favored manner. This is why the wealthy commonly use this tool, and unfortunately the middle class are not commonly introduced to this tool. What I'm trying to do is bring a tool to the general public that's used quite often with banks, corporations, executive benefit plans, wealthy families, whatnot. Do yourself a favor. Take a look at it. Get the information. Contact us at 866-515-6280 or toll free. yourpersonalbank.com. Contact us. Get the information. Ask the questions. Let us show you how this can work for you, how this can be a fit for you. It's not for everybody, but do yourself the favor and take a look. At least take the look and see what it can do for you. Tune in next Tuesday at noon for the Your Personal Bank Show.
Listen next week at noon for more information on Your Personal Bank. Contact Ference at 866-515-6280 or online at yourpersonalbank.com.